Welcome back to the Trade and Justice Podcast, episode number, Mark, we're on 357.
357.
357 podcasts. That's quite awesome. And I do look forward to the next 357. But in our feature presentation here today, I'm very happy that we have the great Tyler Craig, Coach Tyler. He puts on cash flow condors, like Mark says. He does a lot for our community over there at Tackle Trading. A wonderful coach, wonderful mentor for legacy education as well. And Tyler, you're an expert on volatility and implied volatility, and how stocks behave around earnings, and how to, as a trader, position yourself to make money in those very volatile conditions. First and foremost, Tyler, what role does straddles and strangles? And take a moment to describe, please, what a straddle and a strangle is, and what role do they play in your playbook?
Sure. So if you break down all of the different option strategies, right, the dozens and dozens and dozens that people play with, there's really three buckets they fall into. Bucket number one is direction, where you will see traders going bullish or bearish, right, if they have an opinion on which way the stock's going to go.
And we call that delta, right?
We call that delta, yes.
Yeah, so delta stands for direction. So if I buy a call option, for example, I only make money in one direction of the market. That stock has to go up. If that stock goes sideways, we're going to lose money on time and most likely volatility. And if the stock goes down, obviously, we're going to lose on time delta and so on and so forth. So that is a directional strategy, and that's what we refer to as delta. The second one, Tyler, would be theta. And take a moment to describe what theta is.
So D for delta, D for direction, T for theta, T for time decay. So this is where you hear us talk about cash flow trading, which are trades that have the ability to profit from the passage of time. Some of them have a mild directional component, but what we're really trying to do is position a trade where we're primarily banking on just the passage of time. So theta is going to be your dominant Greek in that type of trade. That could be something like a cover call. That could be an iron condor. That could be a bull put spread, a butterfly, something that has a really good positive theta where that's the primary driver of the bus, so to speak. Hence
what we were talking about with oil, or the bull put spread, finding a way to cash flow on it, so on and so forth. Very high probability trading. Probably the highest probability trading you can get is theta based, but you also have limited upside. You're giving up some of that upside for the increased probability. And the third, Tyler, would be Vega, and that's what we're here to talk about today, is volatility trading. And in terms of volatility trading, how would you describe that to somebody literally fresh off the boat, don't understand it in any capacity?
The word that we use is magnitude, meaning the size of the move. So volatility trades are all based around how much the stock's going to move, whether it's up or down. And so you can either place a long volatility trade where you're betting the stock's going to move a lot up or down, either direction. Or you could do a volatility trade where you're betting it's not going to move that much. So you don't really care which way it goes. You're expressing the opinion that it's either going to move more than anticipated or that it's going to move less than expected.
And so in volatility trading, a lot of this is done around known events. I remember one of my team members when I'm out there teaching for Legacy. Her name is Tracy Fasano. And Tracy's been on the podcast before as well, but she's a long-term investor. That's her approach to the market. She buys a stock, she's going to rent it out, she's going to capture the dividend, she's going to watch paint dry on the wall, and that's all she cares about. And I remember it was right after the election in November 9th of 2016. And I'm teaching an event like 2 weeks later, and Tracy and I are on the team. And Tracy is just so excited to see me, And she comes up, and I'm up there teaching, right? And I'm teaching a topic. And usually when I'm teaching a topic, Tracy's not listening and paying attention to me. She's heard that from me a million times, right? And I was talking about, volatility trading, Vega-based trading, straddles and strangles, and everything we're talking about here today. And she says, Matt. And she never does this, like literally ever. And I said, what? And she goes, you're going to be so excited. I'm like, okay. Like, she literally stopped the class for this. And I was like very, very confused. And she goes, guess what I did? I'm like, I have no clue what you did. And she said, I made my first straddle. And I'm like, oh, what? Why? Because there was no earnings. I mean, we weren't going through earnings season. That had gotten over to like 3-4 weeks beforehand. And I said, well, what? And how? And why? And all this, right? And she goes, well, I just felt like before the election, I didn't know how the market would respond, but I thought it was going to be crazy, right? And I said, okay. And so you did a straddle. And she says, yeah. So I just went to the playbook, which, we have our playbook at Tackle Trading. And on that playbook, it lists out all the rules, all the guidelines, what to look for, all that jazz, right? And she goes, I went to the playbook, and she calls it the cookbook. I went to the cookbook, and the whole logic was I just felt like the market was going to respond crazy to whatever occurred. Up or down, she did not know. And she just bought a call based on the rules, bought a put based on the rules, and made 17% in 2 days.
Nice.
That's a straddle. It's not knowing where the direction is going to go, right? Straddles and strangles. It's not knowing exactly where the direction is going to go, but we know there's an event. And typically speaking, those events, they can be political like elections and so on and so forth. They can be individual news coming out of a company sometimes. They can be an economic report, a major economic report. But most of the time, guys, let's face it, we're doing these on earnings. So, Ty, describe the importance of an earnings report, and you talked about the market anticipation. And how does the market, put out their anticipation for what they think this report is going to do?
Sure. So 4 times a year, we got earnings season. This is when public companies, release their quarterly profits or losses. And it creates usually a shock to the stock price. And so there's a great degree of uncertainty around what's going to happen to the stock with that event. If the company delivers, maybe the stock gaps up, right? Maybe gaps up 5, 10, 15% overnight. If they perform poorly and disappoint, it could gap down a lot. So we have this event, we call it a binary event, where essentially there's kind of one of 2 extreme outcomes. And ahead of the event, you really don't know which one it's going to be. And so it creates a unique situation that you usually don't have to deal with, where you're expecting big volatility, but you really don't know which direction it's going to be. And so some people will then say, okay, are there ways to play with that earnings announcement? Can I build trades around this event that have the ability to profit? And that's where you could make a directional bet if you wanted to, but you really don't have an edge. And so it's more popular, Matt, to where you play the volatility, the magnitude of the move, as opposed to the direction.
Well, I just kind of feel, Ty, that, I mean, honestly, if anybody ever comes out and says they know how Apple's going to respond around earnings, and what I mean by that is up or down, or how Garmin is, or AMD is, or whatever the case is, I just always say, no, they don't. Nobody has any clue how the market's going to respond to this event, because there's multiple things that are announced in an earnings report. You have the analysts come out and give their projections, right? What do they think the earnings per share number is going to be? What do they think the forward guidance is going to be? What do they think their revenue is going to be? And they come out with these predictions, right? XYZ company is going to make $2.3 per share. It's going to have, $8.9 billion in revenue, and guidance is going to be reaffirmed. And that's going to be the standard. See, I was talking to a group of new students, and I was like, guys, the thing you got to realize is that in a recession, you judge everything based on zero, whether you have a job and have a check or not, whether you're making money or not. In a recession, Apple's still going to sell $50 billion worth of goods. It's not based on it's never based on nothing. It's not based on the zero. It's based on what these analysts come out with their projections, and then the market, okay, in terms of kind of figuring out that expectation, right? Because we're betting that it's going to either beat the expectation or it's not, correct, Ty?
That would be one bet, yes.
Okay.
And the reason I say one real quick, Matt, is even if you bet right that they beat the expectation, the unknown, and you're probably going to get to this, is you still don't know how the stock's going to react.
Yeah, you still don't know, right? You have no clue how the stock's going to react. And so what's going to happen is the analysts are going to come out and they're going to give their projections on earnings per shares and revenues and forward guidance. And then the market maker is going to set forth their expectation. They think it's going to move $3 or 3% or whatever it is, right? And it's that what we're analyzing. It's not whether they're going to make money or not. It's if they're going to beat what the analysts think they're going to do. And on earnings, it can absolutely fly. So because we don't know, all we know is this known event is occurring. The analysts are going to come out and give their market maker expectations, the MMM number, and then we use that to analyze whether or not we think it's going to go more or less, correct?
Yeah, 100%.
Oh, let's take a stock like, what's the stock reporting? Netflix?
Yeah, reports this week.
Okay, let's take a stock like Netflix. NFLX. Okay, so Netflix reports, what is it, Tuesday, I want to say? Tuesday night? Tomorrow night.
21st.
Yep.
Yeah, 21st.
Tomorrow night.
Evening, yep.
So Netflix reports earnings tomorrow night. Now, Netflix has an expectation of moving $24 on the announcement. That's what kind of the expectation is. Because historically, Netflix moves a ton on earnings, correct? And so we have this historical data on Netflix moving a tremendous amount on that. So how do you go about analyzing what you should do on Netflix, Ty?
Well, so it helps to know what the baseline is, because this is a common misconception that people say, well, hey, this is easy money. I mean, I know it's going to move on earnings. I know it's going to move a lot. I'll just always buy straddles into earnings. And it's like, well, don't you think people know that? Like,
yeah, don't you think that's built into the volatility?
Yeah, it jacks up the price. And so they get pretty expensive ahead of time. The market's pretty efficient in pricing in the magnitude of the move. So
the market's not going to let us traders cheat.
No, there's no free money there. They're not going to let you buy a straddle for $2 and then the stock moves 24, and you make
well, and okay, and let's go on that type, because I think that's an important point. That $24 expected move, that is built into the value of those options this week, right?
Yeah,
and that's what we're talking about. You can't just go buy a $2 straddle and expect to make money, because historically Netflix moves $24. Right.
Well, that's the thing about like arbitrage and risk-free opportunities. Let's say they were $2. Let's say they were $2 a week before earnings. People much smarter and much faster than you and I would spot that this is ridiculously underpriced. They would say, obviously, Netflix, based on its history, could move more than $2. They would run in and buy the crap out of those calls and puts and bid up the price of the straddle until it got to a more fair price of around $24.
Yep.
And so it gets arbitraged away. Like, there's not risk-free money sitting there. And so the question now is, what's your opinion? Like, do you think Netflix is more likely to move more than $24? Or do you think that that's pricing in too much movement? Where your opinion lies is relative to that $24.
Well, I agree, Ty, but just to kind of go into a tiny bit more detail on that, I think it's even beyond the $24, right? Because what's going to happen is once the event is announced and now this unknown event becomes now a known event, that volatility comes out of it tremendously, right? So in my opinion, if you're going to buy a straddle coming in a day before earnings, you got to have the expectation it's not going to move 24 points. You got to have the expectation it's going to move 35 points type of scenario, in my opinion. Most of the time we like to sell that volatility, but how do you build your personal expectation? We know the market's going to give us our expectation. A lot of us use Thinkorswim through the TD Ameritrade. And if you just click on the Analyze tab or the Trade tab, you can kind of understand that market maker move. It's right there. It's $23.94. Another way you can kind of determine how far this can move around earnings is looking at the front week's options as well. And that's pricing in right around $25, Ty. And so you have a market maker move at 24. You have at the money straddle price at about 25, $26. And that's the expectation move throughout the rest of the week, not just on the market maker move. So it's the market that's going to determine what they think, either by us looking at the money straddle price or the market maker move. But how do you go about finding your edge here?
So what I will say is, assume I know nothing for a second. And what would be your expectation? Like, is the market always right? The way that the math works, that $24 is a 1 standard deviation move, which means about 68% of the time it should move that much or less. So Matt, I assume that about 2 out of every 3 earnings announcements move at or less than the expected move, right? So I know that the odds are against me if I buy a straddle or if I buy a strangle. I do that 100 times. I'm probably only going to win about 32 times. I'll lose 68. So that's kind of why we favor selling vol into earnings, because 2/3 of the time you're probably going to be right. And so if you sell volatility via a short strangle or an iron condor type of trade where you're not picking a direction, you're just betting it's going to move less than expected, you probably will win about 6, 7 out of 10. And then it just becomes a management game, Matt. Like, how do you manage it when it goes against you? What do you do with 1/3 of the time that it moves more than expected? That'll really drive whether or not you're successful with it.
Well, and Ty, even when we're the day take Netflix tomorrow, I mean, I guarantee in the halftime report tomorrow, we're going to be talking about, building a trade through either one, we think Netflix is going to exceed the 24, or we think Netflix is going to not exceed the 24, right? And even when you think there's that 1/3 of the time that it's going to exceed the 24, you're still selling the volatility, right? You're still selling that through debicons or inverted butterflies. Okay. Whenever you're buying the volatility, because I think this, outside of everything we've been talking about, I think one of the most important aspects of understanding all of this is understanding implied volatility, and how implied volatility starts to rise about 6 weeks before the earnings. And then it, crushes, volatility gets absolutely crushed coming out of the earnings. And so if you're going to do long straddles, long strangles, where you're creating a bi-directional position around the earnings, I really think that trade needs to really start not a day before earnings or the day of earnings. I think that trade needs to start about 4, 5, 6 weeks out. Don't you agree?
Well, yeah, and it goes to show that there's 2 ways you can use earnings to kind of influence your decision making. One way is the first thing that we were talking about, which is like a pure play on that event overnight, right? Like some people will place the trade the day of earnings, take it off the day after, then it's just a pure bet
selling the volatility through butterflies,
Yeah.
condors, short strangles, all those strategies, right?
Yeah, and then buy it back the next morning. But now you're referencing the other way that you could use earnings, and that is understanding the cycle that happens around those quarterly events where options get expensive ahead of time and they get cheaper afterwards. There's that kind of explains the whole ebb and flow of implied volatility over the year, because for individual stocks, earnings is really what drives that cycle. And so, yeah, you can now say, okay, I understand that options usually trough, they're cheap 6 weeks ahead of earnings. You can try to play that volatility rise in the weeks ahead of earnings as another way of kind of profiting from.
And I do like that. I do like that approach to it. You're getting in when the options are at their cheapest, about 5 to 6 weeks before the earnings. You're creating a bi-directional type scenario where you can capture both the rise in volatility as well as the directional nature if you do get a run up. But even if you don't get a run up before the earnings, implied volatility can still offset the theta, and you can still make a decision whether or not you want to hold that through earnings, given the fact that you purchased them at a fairly cheap price. It's a different form of analysis than we're doing here today, but we'll do that in another podcast, buying volatility coming into the earnings. But let's get back to what you were talking about with selling the volatility the day of earnings. And we were talking about how you personally set forth your expectation here, Ty. Again, just to kind of recap, we know what the market does. It's efficient. It's going to price in the expected move. It's not going to allow us to cheat, buy a cheap option before the earnings announcement and capture a $24 price movement on Netflix. So the options market is very, very efficient. It's going to build in their expectations. How do you personally set forth your expectation on whether or not it is going to beat the expected, market maker move? How do you build your expectation?
Honestly, I have 2 answers, Matt. My first answer is I just assume my fallibility, and I assume the market's going to be right 2 out of 3 times.
And that's where you go, that 66%.
Honestly, think about it. I mean, what's the alternative? The alternative is me saying, I think most of the time I can guess, when it's going to move more than expected and when it's not. And honestly, I haven't proven that to be the case, right? For me, it would become more a question of how would you build a trade around the expectation, not how would you determine if you think Netflix is going to move $30 or $35? Because the answer to the second question is I don't know. Like I really don't know. I could say go look at the prior earnings announcements, look at its ATR, how much does it typically move? But each earnings is unique, right? I mean, they're gonna echo prior earnings, but they are unique. So I don't know that I really could articulate an edge in terms of, well, just look at this, and this, and then, most of the time it's going to move more than expected. To me, a more interesting discussion is just what kind of a trade would you build around that then, So my default assumption is 2 out of 3 times it moves less than expected. So I would peg 68% chance Netflix moves less than $24 this week.
Well, in the last few earnings announcements here, and I like what you said about looking at that historical data, but I agree, Ty. I mean, we've all done that. We get these ideas in our head. And we're like, okay, let's go analyze the last 8 times Netflix announced earnings and how many times did it beat and how many times did it not. And a lot of times, Tyler, that's about where the market maker move is, right?
Yeah, and it's like, oh my gosh, I just reinvented the wheel, right? I just spent 3 hours analyzing all the data to discover, I guess the market kind of did that for me.
I guess the market actually is efficient. You know what I mean? I called one of the trade desks on TOS at one point, and I asked them how they determine the market maker move. And the gentleman was, well, we have this advanced algorithm and blah, 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 blah. And I said, yeah, but doesn't that advanced algorithm all just kind of average out the last 4? I mean, that's really kind of what it is. Yeah. So I agree with you in terms of that, just trusting that 66%, 2 out of 3 times the market. And this is what we see. People build these amazing anticipations, right? But most of the time it just comes out and life goes on, the market goes on, traders go on. It doesn't shock the world. It's just one event that we get 4 times a year that drives all of us crazy a little bit, right? And we just move on. So if we're going to trust the data here, Ty, and we're going to trust that 2 out of 3 times, the market will not move in line with the expectation, correct?
Yep. It'll move less.
It will move less, right? And we're not saying a ton less, but it's going to move less. And if it goes less, we're gonna be able to make money based on certain strategies, like whether you're doing iron condors or short strangles.
Yep.
So, what is your strategy? Because you're going to trust the data. But what is the technique you like to go to on a company like Netflix to put yourself in a position to make money in that environment?
Well, I think that the straddle and strangle are like pure plays, and they're open-ended risk when you sell them, right? So just to be clear here, you can buy a straddle or a strangle and bet it's going to move more than expected. What Matt and I are more talking about is taking the other side of that, betting it's going to move less than expected. Yeah. So you can sell an out-of-the-money call and an out-of-the-money put, which is a strangle, betting that they're overpriced and the market's not going to move that much. And, it's attractive because you can usually get pretty far out of the money, get a wide range in a stock like Netflix. But A, it's expensive. They will tie up a lot of money. And B, you have theoretically unlimited risk. And so I think that for most people, a more sane way, a more comfortable way of trying to play this, Matt, would be selling that strangle, but buying protection at the same time, which is what we call an iron condor.
Well, and they're the exact same technique, right? I mean, they're not dramatically different. The difference between an iron condor and a short strangle is you're selling the same strike prices, the same call option, the same put option you would be doing on a condor. The difference is you're going to go out there and take a little bit of that cash flow and you're going to buy some protection to offset some of that risk, correct?
Yep, 100%.
Now, you are mitigating volatility a little bit there, Ty, though.
Yeah, it's less of a pure play, but it's you ask 99 out of 100 people and they'll say it's worth the peace of mind.
Oh, I 100% agree with you. I was not debating the thing because I prefer always covering risk if you can.
Yeah,
right?
And the sacrifice is you give up some of the reward, but it's
Well, I was watching your video actually, Ty, just on Saturday. And I played one of your videos from Cash Flow Condors to my class. Mm-hmm. And it was on the bull put spread and the bear call spread. It was just the introductory to those 2 strategies. Yep. And you were talking about how you can sell this put option at $90. But what happens if it goes to $50? Well, you have tremendous risk there. So instead of just selling that put option at $90, stock price was $100, why don't we just go buy the 85? Yep. And we lock in some of that risk. So if we got to have the stock put to us at 90, we get to put it to somebody else at 85. The max we can lose is the $5 instead of the $40. Correct?
Yeah, you're a good student, Matt. You listened to the video.
I did. I listened to. I literally sat in my class and watched it. I did. I did. And the whole time I'm thinking, he draws a lot better than I do. Like that's everything that was going on in my head was. Your drawing ability is top notch there, young man. So Ty, when you're looking at a short strangle versus an iron condor in any option system, like literally, you have two basic rules that you have to cover. The first thing you have to do is you have to set forth the time frame in the trade. Now, typically, Ty, when we're selling options, we're doing it shorter time frames, and when we're buying options, we're doing it in longer time frames, and that's to cover the risk to theta. But we're not here to teach that. How do you determine the amount of time? Let's make this Netflix trade tomorrow. The first thing, Ty, I got to pick is the time frame I want to work in, right?
Yep.
How do I determine that?
It's a matter of, do you want to be aggressive or conservative? And the rule of thumb with condors is we're usually around 30 to 60 days would be a traditional condor. There are people, Matt, who will do you could build a strangle or a condor on Netflix using options that expire on Friday, 4-day options. It'd be 3-day options if you put it on Tuesday. And what happens is you get like instant resolution, right? Either you wake up very happy Wednesday morning because Netflix didn't move very much, or you're going to get close to max loss pretty quickly. So if you use like a 1-week option and build this condor.
There's that max loss again.
That's right. I should cede the floor here to max loss.
You started something.
Yeah. So, but it's more aggressive, right? So if you want the instant resolution, you can use like a 1-week option. You could do that. I think most of us prefer to have a little more margin of error. I'm willing to not capture the reward as quickly. And so my default when I build these with students is usually 1 month. So I'd be using like the Fed monthly options here.
Okay. So let me look at two trades here, Ty, because I think it's an important point to point this out. The option the weekly options that expire this Friday, you could put this trade on tomorrow. There's 3 days into the trade. You got some management techniques. We like to sell deltas about the strike prices. That would be the second rule, right?
Yep.
So theta, selecting the time frame is the first rule, whether you're doing a 4-day option or a 30-day option or somewhere in between. The shorter the time frame, the more aggressive the trade, but you capture your cash flow if you write faster. The longer the option, the more room you got, higher probability. But you got to kind of, especially with condors, you kind of got to let that play out, right?
Yep.
So whether you're 4 or 32, you got to pick the time frame first. Then what do you select?
So then you decide how wide you want to put the range, right? Do you want to go just outside of the $24 expected move?
You better go outside that.
That's the minimum, right, Matt? It'd be maybe more aggressive than necessary to go inside the expected range. So at a minimum, I'm going $25 up, $25 down. But I think most of us, Matt, would go a little further out and accept a little bit lower return on investment just to improve the probability.
Okay, I can go to the 305 put by the 300 put.
Yeah, which
that's
is $35. $35.
$35. It's 11 delta.
Yep.
Okay, and then I could go, and I'm building this trade while we're doing it. Then I could go to, on the call side, the bear call. So that's the bull put, the 305 by 300.
Yeah.
The bear call would be 385 by 390, right?
Yeah.
So the bear call would be 385. And I'm just kind of matching deltas there, Ty.
Yep.
So I got a 385 by 390. And I'm just going $5 spread because it's $300 stock.
And that's what I would do on Netflix.
Yeah.
Typically.
And if it was like Google, we would do a 10-point spread or something along those lines.
Agreed.
Now, I can capture 65 cents against 435 buying power per contract, right? And that's right about a 14% projected return on investment with a projection at 89% probability.
Yeah.
Or, so that's trade number one. And I'd say that's a good trade, Ty. You have an edge, right?
Yeah, I mean, you're pretty far out there. 385, 305. I mean, this
but
is
you know
gonna
what,
have some
Ty?
fireworks. Yeah.
Oh, man. We're 46 points on the call side and we're 34 points on the put side. Can you describe very quickly why we have more range selling the same deltas, but more range on the call than the put?
Yeah, so that's a phenomenon known as volatility skew. And one thing we remember is that the price of an option, even though there's a Black-Scholes model, a pricing model that calculates the price of an option, the unknown is supply and demand. And so when an option starts trading in the real world, supply and demand will have an impact as to whether the option gets more expensive or cheaper. And supply and demand for every single strike price in every single month can be slightly different. And it tells you something about the default kind of bias on the market if one side, like the calls, are trading more expensive than the puts. It would be because there's a lot more demand for those calls. And so in situations like this, where you sold, and it wasn't even equidistant, you said it was equal delta.
No, I matched
right?
deltas. Both of them had an 11 delta.
Yeah, so they're both 11 deltas, but the demand for the call is a little bit more than the demand for the put. I think that's what we said, right, Matt?
Yeah, it's the demand for the call side this right now.
Yes.
So basically it's a volatility skew and it's based on supply and demand that happens within algorithms, right?
Yeah, and usually the out of the money puts trade rich to out of the money calls, but in like for the stock market, right? The S&P 500, out of the money puts trade expensive relative to out of the money calls because people fear the downside more than the upside. But in a stock,
this one is a little different though, because usually you can get a little bit more range on the put side than you can on the call side because of the put side's more expensive. This is a little different.
Yeah, so upside speculation for Netflix may just be running hot right now.
Maybe that's just this marketplace that nobody wants to sell anything and everybody just wants to buy things.
Well, it's worked so far. I mean, right?
Yes, it has. Hey, second trade, okay? I'm using same deltas. I'm using an 11 delta on both the puts, the bull put spread and the bear call spread.
Mm-hmm.
I can sell, and this is what you get when you pick more time, like a 32-day contract, right?
Mm-hmm.
If you're going to pick a 32-day contract, you can sell a little bit more wide. And in that little bit more wide, instead of the 305 by 300, we're getting 10 points more range down to 295 by 200. So I'm getting 44 points of cushion on the put side. Yep. We can go up to the, I believe we can go up to the 395 by 400. So we can get another 10 points on the call side, which is going to give us 40. What would that be? 400. It gives about,
what would that be? 55 points?
55 points?
Yeah.
Okay, so we can get 55 points on the call side. We can get 44 points of protection on the downside. You're getting more range. That's number one. What you're also getting, though, is a higher return. And the reason you're getting more cash flow here, instead of getting like the $65 here, Ty, we're getting $95. And the reason we're getting, another $30 in cash flow is we're selling more time, right? Yeah. And so you're going to get more range. You're going to get more. You're going to have more time. You're going to have maybe some more management decisions. But I when I was mapping out the 4-day trade, I could see myself making that trade. But when I'm comparing it against this, getting a little bit more range, getting a higher credit, offering me a little bit more, a little bit more time to manage the trade, I kind of like this 32-day contract here.
Well, and I think the conservative trader is almost always going to come to that conclusion.
And don't veteran traders always become more conservative traders just by nature?
Yes.
They always do. They always do. Ty, last thing. We put the trade on. Obviously, the trading gods have something to do with this on Netflix tomorrow night. Let's say it moves more than the expectation. Because even though, historically speaking, Netflix does not do it. In the last 8 earnings reports, they've only twice actually exceeded that 24 points. Now, it would have been a different number back then. I don't know exactly what the number was. But only 2 out of the 8 did. So it does occur. Trading gods take over, Netflix announces earnings, and let's say that puppy is just flying. And it's up 385 overnight. We have a lot of bullish momentum. How would you go about managing that trade?
Well, there's an easy answer and a more lengthy hedging answer. But the easy answer is I would usually let it open. Sometimes stocks will make the higher low of the day at the open. right? Because you have this huge influx of buy orders overnight. They get filled at the open. And I would hate to close that condor, take the loss the first minute of the day, and then come back in 3 hours and discover I top ticked the stupid thing. So I usually give it a chance to see if it's going to fill the gap. And that may just be waiting 5 minutes, Matt. I don't have to wait 3 hours. I usually let it open and let it trade for 5 minutes, maybe 15 minutes. And I'm assuming it's gapped up here. So then I would mark the high of the first 5 minutes or the first 15 minutes. If it keeps going, I would get out. I would just take the loss and move on. If it started to fill the gap, you got a chance to make some money back.
Well, in a couple of the times, Ty, that it did gap out of the range, I mean, a wonderful point, especially on Netflix, because Netflix has crazy ex-girlfriend scenarios. In Netflix, July of 18 announces gaps down 50 points overnight. By the end of that trading day, it's only down 20 points, Ty.
Yep.
Immediately bought back up. The following earnings, October of that year, it gaps out from 350 all the way up into 381. So that would be a very similar scenario that we're talking about right now.
Yep.
And Ty, by the end of that trading day, a lot of those traders locked in profit, and it came right back down to 363.
Yep.
Netflix, just in its last earnings report, just this one that happened on in October of last year, Netflix 386 gaps up the following day to 310, hits the market maker move, 25 points, and then by the end of the day, comes right back down to 293. I think even if it gaps outside the range, if it's not broken your short legs, I think you got to give it a little bit of time to see how the market is going to respond to it when it's open, not just when those orders were coming in when it was closed.
I agree.
All right. Well, Tyler, thank you so much for this wonderful conversation. You know, I've been trained for a long time, Ty, and I learned something in this conversation. So I really do appreciate you coming on and spending some time with our audience, you know, describing straddles and strangles and earnings and, you know, rules and all of that jazz. And we will be right back after this live read from producer Mark.